I think we have a tendency to kind of build and do things with always thinking about how others would view them. So it's like, what job should I choose that's going to sound the most impressive, or what company should I work at that's going to, turn the most heads when I introduce myself in the room, or from a founder's perspective, like what business should I build that's going to get venture funding, or what are VCs interested in, and then they try to go build that. I don't think that's the right approach.
Hey everybody, this is Amber Key, and you're listening to a Bright Idea podcast, a show that sits down with entrepreneurs to hear about the aha moment that launched their businesses. On today's episode, we're joined by Tori, an investor at Vera Equity. Tori specializes in early-stage enterprise software and AI startups. She earned her MBA from the Wharton School of Business at the University of Pennsylvania, majoring in entrepreneurship and innovation. During her time at Wharton, Tori was awarded the inaugural Hettie Simmons Love Fellowship and the Edward B. Shils Leonard L. Zeidman Fellowship in Entrepreneurship. She also held key positions as managing partner of the Dorm Room Fund and VC Fellow at Harlem Capital. She previously worked at Tesla, Intel, BCG Digital Ventures, and Goldman Sachs in roles that span engineering, product management, venture building, and investment management. She's also a proud HBCU graduate of Spelman College and the University of Michigan, where she earned dual degrees in mathematics and mechanical engineering. Above all, she's deeply passionate about creating opportunities for minorities in entrepreneurship and tech. While this show focuses on the stories of small businesses and startup entrepreneurs, today we're switching it up to discuss a common challenge among many business owners: funding. In this episode, Tori will dive into what venture capitals are, if venture funding is necessary for all businesses, and the steps and approaches you can take to raise venture funding for your business.
I'm super excited to be here. So really appreciate the invitation. And so my background into venture is a bit untraditional. So I started off as a mechanical engineer working in tech. I didn't know what venture capital was. Like first gen, come from, very humble beginnings. So venture capital wasn't a career we talked about growing up. And so I started off in tech, and for undergrad, I went to Spelman, which is an HBCU, and they had this program, this dual degree engineering program. So I also went to Michigan. So I studied engineering at Michigan and kind of went into tech. It was popular amongst, my classmates. And while there, I always felt kind of like I didn't understand the money side of things. I didn't understand why certain decisions were being made, and like how what was influencing some of the decisions behind what we were building. So I started developing an interest to learn more about the finance side. But it wasn't until I started to pursue going to business school that I actually found out what venture was. And it was actually through a program called HBCU VC. And so HBCU VC is an organization that aims to get more minorities into venture capital. So I did their program, and, they introduced me to venture. We did this training. And I was actually able to do an internship in VC the summer before business school. So that's how I kind of stumbled upon venture. So like I said, super untraditional, like don't have a finance background. I came from the tech side of things. So that's how I got into venture. And then I think your second question was, what is venture capital, right? So if I could put it in the most simplest terms, venture capital is funding. So it's money, but it's not free money. So it's not like grants that you receive, or not even like a loan that you would receive. So this money comes in exchange for equity, which means venture capitalists are going to give founders money, and in return, they want a stake of ownership in your company. And the goal behind it is that they give you this money, it's going to help you scale and grow. And in return, as you advance and hit certain milestones and raise more money, and eventually either, have a IPO, which means, going public on the stock market, or you're acquired for a large amount, their equity will be worth something. So they'll make a return on their investment. So that's what venture capital is. And hopefully I hope simple terms.
No, that was really simple, and I thank you for the explanation. Why do you think venture capital is so important?
Yeah. So I think venture capital is so important, and why it's such a buzzword is because if you look at the companies that make up like the NASDAQ, or, like all the top tech companies, I think a large percentage of them started off with venture funding. So, and I don't know the exact research, but I know there is research out there that just shows that venture funding and these companies really like scaled their growth. So when you think of, the largest companies, um, how they got started was through venture money. And so it almost allows it to have a different scale of growth, as if as opposed to someone who's bootstrapping, which means they're paying for everything themselves, or maybe they're taking in grants, or maybe they're, taking loans from the bank. They're not able to move at a pace that you would if you had this large influx of venture capital.
What When we think about investing and people who are investing in companies to help scale their growth, there's two um, things that I'm thinking about. I'm thinking about venture funding, and I'm also thinking about angel investing. Can you kind of differentiate the two for us?
Yeah. So angel investing is similar. It just means, so an angel is usually a high net worth individual, someone who has a lot of liquid cash, and they're looking to invest early in startups. So they typically invest sometimes before the venture capital finds the company. So there are certain rounds. Sometimes they come in the friends and family round, which usually happens before companies raise institutional money, or they could invest alongside a VC, like smaller VCs, in their pre-seed round or seed round. And the only difference is the angel investor is just an individual. So you can kind of think as the angel investor as its own VC fund. It's like your personal VC fund. And their terms are a bit different, but it's the same concept. They're investing, they have so much ownership in the company, usually significantly smaller, because the check that they're investing is much smaller than a VC would typically. But it's essentially the same concept. They're just probably more angel investors, depending on, I guess, what circles you run into. But yeah, you wouldn't have to, there are different processes. So you might not have to like present or pitch a team because it's just one person. So the process might be simpler. The diligence, which just means like going over and seeing, is this a viable business? What types of questions should we ask? Like that might be shorter. So the processes are different, but the concept's the same. The money's just coming from one person as opposed to a firm.
And you're saying the criteria is different as well. Do you think that it would be easier to go through an angel investor rather than a venture firm?
I don't know if I would say easier. My gut says yes, but I don't want to say like, I don't want it to be for everyone, because you might find some angel who's super successful and their process is probably a bit more difficult than maybe like a super angel VC fund. So I don't want to speak in that general, but I think just because the angel is an individual, they can't scale the way a VC fund can. So they're not going to have analysts like running diligence, or associates kind of like running the running point on the deal, and they're doing it all themselves. So I think it just depends on how much that individual can handle. But I do think they're a perfect place to start, because usually they'll have connections to other angels or other VC funds that can help you raise more money. So if you are fortunate to know angel investors, I think that would be a great place to start. So most people start at angels before going to VC funds.
Can you take us through that process? Like once you create this partnership with a business and they're now investing in the company, what sort of, I guess, what do you have to uphold in order to maintain that relationship?
Yeah, I totally get what you're asking. And it's interesting because it depends on the stage. So as I had mentioned earlier, there's the friends and family round, which is kind of exactly what it sounds like. You're going and you're asking your aunties, uncles, cousins, anyone who can help you out to, give you some money, and then also angel investors. And then there's what's called pre-seed. And their pre-seed is becoming more popular over the years. And that's essentially, most VCs offer like a safe, which is a simple, or let's say simple agreement for future equity, I think is what it stands for. I should know that. Um, and essentially that just means before they go out and raise a price round with a, larger institutional fund, this fund is taking a bet on them, and they're going to invest even earlier, sometimes pre-product, pre-revenue. And then you have your seed round, series A, and it can keep going, series B, series, C, D, it can keep going. And so how it's usually split is early stage VC versus late stage or growth stage. And so the process and the requirements are different at each stage. I invest in the early stage. So typically the process looks like, depending on where the product is, if it's pre-product, pre-revenue, that's even different than if they already have a product and they're generating like a little revenue through, like early design partners. So it really does differ, but from what I do, it essentially, the founder has maybe like a coffee chat or a quick meeting with someone on the team. It's usually me as the first person. And then if our call goes well and I'm interested in kind of continuing the conversation, they'll set up a call with one of the partners on the team. And assuming that call goes well, we kind of discuss it internally and we decide to move to memo. So an investment memo is a long kind of analysis that determines or examines, the merits or risks of an investment opportunity. So in that investment memo, and that's typically put together by the analyst or the associate. And so through that memo, they're looking at, what's the problem? What's the solution? The competitive landscape, how this is differentiated. What's the market opportunity? They might do a market sizing analysis. They're looking at basically the business model and how that can grow and stuff like that. So they're kind of going through each piece of the business, the traction they've had so far, the team that they've built, the strength of that team. And essentially the entire VC fund will review that memo and kind of have what's called an investment committee meeting where they decide if they want to invest or not. And it's typically done on a vote. So that's how we do it. And I think typically that's how early stage does it. Once you make it beyond series A, like into more of the growth later stage VC, it's different because then it's assumed that you have more revenue. So they're able to do a bit more, like calculations and analysis to look at the revenue and other metrics like unit economics. So it gets a little bit more technical then because they're assuming you've already found product market fit. So they're not really looking at like the strength of the team and the founder and like what the opportunity could be. They're more so looking at like, okay, what have they done so far? And like, how can our money help them just take this to the next level? So the approaches are a bit different depending on the stage, but that's in general, like what happens.
How long would you say each stage takes? Because if I'm thinking, I was listening to you talk and I was just wondering, we hear a lot about AI is a big thing right now, and all of these companies that are really focused on in the tech space. And how do you guys ensure that these companies aren't growing too fast, or you're not investing too much, and then 6 months later there's a flop with the company? I guess how are you guys managing those expectations?
Oh, Amber, I don't know if they are.
Does that happen? Is that like a
Yeah,
real
yeah,
thing?
that happens, right? Because when you think about Web3, and I was never a Web3 enthusiast, I kind of was very, I don't know if skeptical is the right word. Like, I think Web3 needs to happen. I just think a lot of people hopped on board before they had real kind of use cases, and needed some more investments in like the infrastructure and just changing the attitudes of the end users. So like Web3 was exactly what you just kind of, hinted towards. A lot of VCs, and it's called like hype investing, I think is what they call it. So it's like a lot of VCs can hear like the latest buzzword and hop on board and just invest money in these hot topics without really doing any diligence or kind of critical thinking about, um, honestly, the fundamentals. So you can kind of get lost in this. I think the difference with AI is also pretty hype and like a buzzword right now. And even my firm invests in AI. So we're a part of the problem probably. Um, but I think the difference between something like Web3 and AI is AI has a clear use case. Some of these, and that's the name of the game with venture. Like some of these things aren't going to work out. 90% of startups fail. So I think you're going into it with the assumption that most of these things won't work. We're just looking for the one that does, because usually when you have one big win, it covers all of your failures.
Mhm.
Uh, so I think, one, the assumption is that most of these are going to fail. You hope they don't, but you're kind of like you're going into it with that expectation. And then the other is just kind of how firms prevent that. So there are some firms who are what's called investment thesis driven or research driven, and those firms don't, or typically don't invest on like hype cycles. So they do research on a certain area or areas, and they form an opinion, and they only, so then after they have this opinion, they go out and look for startups that match their thesis. And so
Mhm.
that once they find them, they already know this is something I want to invest in. So I think that's one way to combat what you were referring to, is, this thing could go, like to pieces
Yeah.
overnight. I think that's one way to prevent that. The only downs, and there's always like negatives and positives to everything, pros and cons. The downside of that is you lose out on a lot of opportunities if you're not investing opportunistically. So there's pros and cons to each approach, being a generalist versus specialist. But I think the most important thing is just, if you form your own kind of thoughts into your own analysis, hopefully that would prevent you just investing on hype. Like going back to the fundamentals, like, is there a problem, or is this like a solution looking for a problem?
Mhm. I agree with you that is sort of a buzzword right now, and I think part of it is it's hit mainstream, especially with like shows like Shark Tank and things that everyone's like, oh my God, this is the next best thing. I have a business, I can go on here, I could get venture funding. But I don't think that and you could tell me differently, is every business qualified or needs venture funding?
Definitely not.
Okay.
Yeah, that was the easiest question you asked me. Uh, I don't think, actually, I think most companies don't need VC money. It's definitely a buzzword. I think it also is starting to become a status symbol.
Okay.
You start to see on LinkedIn, most folks will put ran a VC backed company or worked at a VC backed company. So I guess that means something. Um, but yeah, most businesses aren't venture backable businesses or don't need venture money. It might not be the best asset class for that specific business. Um, but unfortunately, like I said, it kind of means something. So um yeah, and I wish I could give you examples, but I don't want to make a fool of myself on camera, because you can say something like, oh, this food business doesn't need venture money, and then there's some example of one that blows up, so
Yeah.
it's, you can't.
No, that's totally fair. I guess what would be helpful though is like what kind of businesses are VCs looking for right now?
Okay. Okay, yeah, that I can answer. So usually technology enabled companies, you know, and that's pretty broad. So it could be across sectors like healthcare. It can be consumer, it can be enterprise, which my firm invests in. It could be fintech. So it's across, many different, I guess, segments. But the base of it is usually that technology enabled. They're looking for things that can scale. The idea is they want it to become a unicorn, right? So that means, worth $1 billion or $1 billion valuation or more, ideally. So most businesses, don't make it to be that. They become maybe like $100 million business or $300 million business, which is great for a lot of people. It's just not on the venture scale good. So that's another way to kind of think about, like, is this a VC backable company or not? Um, yeah, I would say that's what they're looking for.
What can you tell us like the difference between a small business and a startup?
Yeah. Yeah, it's kind of a nuanced thing. So a small business, I think, and this is just my personal opinion. I don't know if this is like the dictionary. How I would think about a small business is they tend to want to stay small. So think about your local mom and pops, like coffee shop, or maybe a bookstore. Maybe like some type of like soap place, or these like kind of crafty, or maybe like family owned, family ran businesses. That's what I think of when I think small business. Maybe like a tax preparer, independent tax preparer, something that's small and tends to stay relatively small, and usually ran by like a family maybe. Whereas a startup from day zero always has plans of getting big and like turning into this huge thing. So I think if I had to say what I think the differences are, is just kind of like the scale. Small business is small and it tends to stay small, whereas a startup is literally just starting up to become bigger and aims to be like, this huge Amazon or Apple, Microsoft, some like large company.
That's awesome. What would you say are some common misconceptions about venture capital?
I don't know if they're misconceptions, but I think maybe some like assumptions that aren't always true, but of course, there's always like some truth, and stereotypes is that they're not helpful. Um, they kind of get a bad rep of just like wanting to take all the ownership in your company, and they don't really help out. There are VCs out there who really do care about helping, and you just have to be really selective about who you choose to partner with. So that's one. Um, and I think also, just depending upon the stage, um, another misconception might be that they don't really care about what you're building, or like this is just another opportunity. They see thousands of pitches. I think in general, VCs really do care and they want to help, but unfortunately, they have a fiduciary duty to return the money to their LPs. LPs are limited partners. So they're not investing their own money, they're investing money that they borrowed from someone else. So it's like a
Mhm.
long chain of investing. LPs are investing in VCs, and then VCs are investing in entrepreneurs. So they simply can't say yes to everyone. They say no much more frequently than they say yes. And I think that kind of comes across as a bit cold. But when you kind of understand that change that I just explained, like that's the way it is. That's why it's like that.
Now, I know that VCs obviously want to invest in companies that have like a great idea or know that it's going to turn and it's a scalable business. But are they also looking at the company's bottom line, like how much that company already has in their bank account?
It depends on the stage. So at pre-seed, it's not typically assumed that they have a bottom line. If they do, that's amazing. But that's not typical. Now, as you get further out, like I said, maybe seed, series A, series B for sure. Like that's when it's expected that you have revenue, and they're looking very closely at your financial statements and seeing like what's your burn rate, which means like how much cash are you spending, and how are you spending it. So all those metrics become extremely important in the later stage. But like I said, early stage is more so just trying to figure out if you've got a real solution here to a real problem. and people want it.
So can you tell our listeners how they should go about raising capital if they are interested in venture funding?
Yeah. So first, if you're interested in venture funding, and this is assuming you've, excuse me, exhausted all of your options to get free money first. So look for grants, things that you call for pitch competitions, anything that doesn't require you giving up ownership in your company. I think you should exhaust all of those options first before going after venture funding. But assuming you've done all that and you are ready for venture funding, I would first make a list of VCs that maybe you have a common connection with someone on LinkedIn that you can get a warm referral. A lot of this business is through warm introductions. It's a who you know business, unfortunately, which tends to put founders like of color at a disadvantage. But that's a place to start. You always want a warm intro. And if you don't have a warm intro, I would make a list of VCs. You can Google this, there are tons of lists, and look for VCs who specialize in what you're building. So if you're building an AI solution, Google, a list of VCs who specialize in AI. Or if you're a minority founder, meaning Black, Latino, or woman, look up, VC funds who invest exclusively in you. And so that's where I would start. And from there, it usually expands because they can refer you, even if it's not a good fit for their firm, they'll pass what's called deal flow. They'll pass that to another firm who it might be a better fit for. And then before you know it, your list started as 10 firms and now it's grown to like 50. So yeah, ideally get started with the free money, like I said, grants, pitch competitions, stuff like that, accelerators. And then look and see who you have in your network. Maybe they're one person removed, ask for a warm intro. And then after that, look at firms that are, similar to what you're building or your demographics, et cetera. There are firms that invest in only like certain states. So I know specifically with Black founders, they're trying to rebuild Tulsa, Oklahoma. We had the Black Wall Street there before the massacre. And so there are some firms who want you to like relocate to Tulsa. And so, yeah, it might be like location based. Maybe it's like for folks who are in DC or they only invest in the Southeast. So just look up, everything that pertains to you as a founder and target those people first. And then hopefully from there, your list will expand as you ask. You can also give VCs permission to share your deck or share what you're building with other VCs who might be interested.
I like that you're mentioning Black and Brown founders because we haven't spoken about that in this episode, but I really do think that not only are VCs a buzzword, as we've mentioned several times, but we are seeing more access for Black and Brown business owners to be able to receive funding from venture capitals, which I think is great. But I also have some statistics that I want to mention here, and I'm just going to read it off. But according to McKinsey and Company in 2022, Black and Latino founders received just 1% of venture funds dispersed across the U.S. and 0.1% of all of the funding last year went to let me just reiterate that only 0.1% of all funding last year went to female founders who are Black and Latina. But at the same time, women of color are starting businesses at a rate that far outpaces any other demographic. And I bring that up to mention that in addition to that, right now, Edward Bloom, who I'm not sure if you're familiar with, he's a conservative activist who brought down the affirmative action. He filed a lawsuit against the Fearless Fund, which is a venture capital firm that backs startups led by Black women. And I just want to know, like, while we're talking about how Black and Brown businesses can go out, or Black and Brown businesses and startups can go out and look for venture funding, like how, when we have sort of this attack happening right now, how can we protect ourselves and one another? And I'm not sure if you have the answer to that, but I just want to know if that's something you guys are thinking about.
Yeah. It's definitely a loaded question, and I'm very familiar with what's going on. It's really hard not to, because everyone's nervous. No one knows what the future holds. I will say though, for that lawsuit, it wasn't suing the Fearless Fund for investing in, Black or women of colors. I think their thesis. It was for a very specific grant program
Mhm.
that they offered. So they were suing for that grant program, I think. So it wasn't an attack on the VC fund as a whole, but it was just that specific grant program that they were offering. Um, and so it is frightening because for anyone following what's happening, like we know these are just looking for something to stick, right? Like they have bigger plans to undo a lot of progress. So that's frightening because you don't know what the future holds. But I would say I think it's scary from the VC's perspective because, folks or VCs that really do care. So I think from a VC perspective, it's scary because if your whole firm is based on, closing that gap and investing in diverse founders, you're kind of wondering, like, can I continue to do this? Um, from a founder's perspective, I don't think they should be worried because the money will always be there. So even though these other VC firms don't exclusively invest in minority founders, they still can invest. So it's more so like getting access to them and getting that, like, that's a different battle,
Mhm.
but at the end of the day, like, speaking on the most basic terms, like the funding is available. Whether it's accessible, that's a different conversation, but it is available. So as a founder, I wouldn't be afraid. I think in VC investors who specifically invest in minorities, like that's the whole thesis behind their fund. I think that is where it gets a little bit scary because who knows? Like we don't know if these things will, I hope they will exist in a few years. So, but from a founder's perspective, I don't think they should be afraid. I think, if you build a business that's is good and you're, very promising and you've got customers and you're going to blow up, like at that point, everyone's gonna want to invest. They don't care what race you are.
Mhm.
So I know it's a little bit toxic and something we've all been told since kids is like you have to work twice as hard to get half as much. Um, I mean, it's sad, but sometimes it's true. So it's like you build a business good enough, like they're all gonna want you. So
Mhm.
I wouldn't be afraid of that from a founder's perspective, but definitely like VCs who want to create a VC fund one day that, invests in minorities, like I think that's kind of up in the air, possibly. That's the scary part.
I wanted to give you the mic once again, just to, if you have any last words or any advice or anything we haven't touched now that you think our listeners would like to hear.
Yeah. I think, and this is some advice I've been working through myself. I just, like I mentioned, graduated from Wharton with my MBA. And as I was picking my career, um, I think we have a tendency to kind of build and do things with always thinking about how others would view them. So it's like what job should I choose that's going to sound the most impressive, or what company should I work at that's going to, turn the most heads when I introduce myself in the room, or if from a founder's perspective, like what business should I build that's going to get venture funding, or what are VCs interested in, and then they try to go build that. I don't think that's the right approach. I think following doing building a business should come out of a need. Like you're solving a need, you've discovered a problem, you want to solve it, or you have some innovation, and ideally, hopefully you're passionate about it, because and if not passionate, at least like just extremely driven to build it. Because I think, once you get told no so many times, like you need something deeper than just wanting to do something because it sounds cool to keep you like dedicated and driven on those like stormy or cold days when you've gotten like 100 no's from BCs.
Mhm.
Uh, so I'm not necessarily saying like chase your passion, because anyone who's been to business school will tell you like that's bad advice.
Mhm.
That's what they tell us in all of our classes, like that's bad advice. So I'm not necessarily saying that. I'm just saying have a reason other than like what other people think to be your reason for pursuing and like keeping up with something. Like make that reason something real and something personal to you. So even if it isn't passion, like maybe you just are extremely driven to cure cancer, or make people like us use chat GPT in a easier way. Like whatever the problem and solution is, like
Yeah,
you need a deep kind of drive to stick with it through the hard times. That's not superficial.
I love that. Thank you so much for your time today.
Thank you, Amber. This was awesome.
Thank you, Tori. That's it for this week's episode of A Bright Idea. Tune in each week as we interview entrepreneurs to find out their aha moments that launched their businesses. Today's episode featured Tori Orr with Vera Equity. If you would like to know more about venture funding or anything we did not touch on today, Tori can be reached via LinkedIn. Her name is spelled Tori and last name Orr, ORR. We hope that you enjoyed this little bit of education and that it encourages you to find the funding you need to grow your business. Tune in next week for another episode of A Bright Idea featuring a new entrepreneur. Until next time, I'm Amber Key.